crucial for maintaining discipline, especially during periods of drawdown or market volatility. It reassures traders that their strategies have been rigorously tested and are likely to yield positive outcomes over the long term. In summary, backtesting trading strategies is an essential practice that helps traders validate, refine, and optimize their strategies using historical data. It provides valuable insights into the strategy's performance, helps identify optimal settings, and builds confidence in its application. By thoroughly backtesting their strategies, traders can enhance their chances of success in the dynamic and unpredictable world of trading. Gold is forming its candles. Forex, gold and crypto trading can be facilitated through either traditional brokers or proprietary trading firms, prop firms, each offering distinct advantages and disadvantages depending on a trader's goals, experience, and resources. Understanding the differences between these two options can help traders make informed decisions about where to direct their trading efforts. Brokers provide individual traders with the platform and resources to trade in the market. Brokers typically offer a range of trading accounts, from standard to ECN, electronic communication network, accounts, catering to both retail and professional traders. They provide access to various trading tools, educational resources, and customer support, which can be particularly beneficial for novice traders. Brokers earn through spreads, the difference between bid and ask prices, or commissions on trades. This model allows traders to maintain control over their capital, strategies, and risk management. However, trading with brokers requires personal capital, and the potential for loss is directly borne by the trader. In contrast, proprietary trading firms, prop firms, operate differently by allowing traders to trade the firm's capital rather than their own. This setup significantly reduces the financial risk for traders while providing the opportunity to earn a share of the profits. Prop firms usually require traders to pass a rigorous evaluation process to demonstrate their trading skills and discipline. Successful candidates gain access to the firm's capital and resources, such as advanced trading platforms, professional development programs, and mentorship. This model is particularly attractive to skilled traders who lack sufficient personal capital but possess the expertise to generate consistent returns. One of the main advantages of trading with a prop firm is the leverage provided by the firm's capital. Traders can take larger positions than they could with their funds, potentially leading to higher profits. Additionally, prop firms often cover the operational costs, including trading platforms and data feeds, which can otherwise be significant for individual traders. The support and structured environment of a prop firm can also enhance a trader's performance and discipline, thanks to the access to seasoned professionals and a collaborative trading environment. However, trading with prop firms comes with its own set of challenges. The evaluation process to join a prop firm can be stringent, with a focus on risk management and consistency rather than just profitability. Traders may face pressure to meet performance targets and adhere to the firm's risk management policies, which can limit trading flexibility. Furthermore, profit splits between the trader and the firm mean that traders do not retain the full earnings of their successful trades, unlike in personal accounts with brokers. In summary, choosing between a broker and a prop firm depends largely on a trader's individual circumstances and goals. Brokers offer autonomy and full control over trading strategies and profits but require personal capital and bear the full risk of losses. Prop firms, on the other hand, provide the opportunity to trade with substantial capital and professional support, reducing personal financial risk but often at the cost of profit sharing and adherence to strict performance criteria. Traders must weigh these factors to determine which option best suits their trading style and financial objectives. Our expert advisor is reading candles. Trading hammer and inverted hammer candles involves understanding their formation, context within the market, and confirmation signals. These candlestick patterns are indicative of potential reversals and can be powerful tools for traders when used correctly. A hammer candle is characterized by a small body at the upper end of the trading range and a long lower wick. This formation typically occurs at the bottom of a downtrend and signifies a potential bullish reversal. The long lower wick indicates that sellers drove the price down significantly during the session, but strong buying pressure brought the price back up near the opening level. This buying interest suggests that the downtrend may be losing momentum and buyers are starting to take control. To trade a hammer candle, look for confirmation of the reversal signal. This confirmation often comes in the form of a subsequent bullish candle that closes higher than the hammer's close. Entering a long position after the confirmation candle helps reduce the risk of false signals. It's also advisable to place a stop-loss order below the hammer's lower wick to protect against further downside. Additionally, analyzing volume can provide further validation. A hammer candle with high trading volume indicates stronger conviction in the reversal. An inverted hammer candle, conversely, has a small body at the lower end of the trading range and a long upper wick. This pattern usually appears after a downtrend and suggests a potential bullish reversal. The long upper wick demonstrates that buyers pushed prices higher during the session, but sellers managed to bring it back down. Nonetheless, the buying interest signals that the downtrend might be weakening. Trading an inverted hammer involves similar steps to trading a hammer candle. Wait for a confirmation candle that closes higher than the inverted hammer's close to validate the potential reversal. Enter a long position after the confirmation and place a stop-loss below the inverted hammer's low to limit risk. Volume analysis can again be useful. A significant volume on the inverted hammer day can indicate a more reliable reversal signal. Both hammer and inverted hammer candles are most effective when they appear at key support levels or within a broader technical context, such as at the end of a retracement in an uptrend. Combining candlestick analysis with other technical tools like moving averages, trend lines, or Fibonacci retracement levels can enhance the accuracy of these patterns. Patience and discipline in waiting for confirmation and managing risk are crucial for successfully trading hammer and inverted hammer candles. The key to trading success is emotional discipline. Leverage is a powerful tool in Forex and gold trading that allows traders to control large positions with a relatively small amount of capital. By using leverage, traders can amplify their potential profits, but it also comes with the increased risk of significant losses. Understanding how leverage works and managing its use effectively is crucial for successful trading. In essence, leverage is the ratio of a trader's own capital to the borrowed capital used for trading. It is commonly expressed in ratios such as 50 to 1, 100 to 1, or even 500 to 1. For example, with a leverage ratio of 100 to 1, a trader can control a $100,000 position with just $1,000 of their own funds. This capability allows traders to participate in larger trades than they could with their own capital alone, potentially leading to greater profits from small market movements. Leverage significantly magnifies both potential gains and potential losses. While a small price movement in the desired direction can result in substantial profits, an adverse movement can quickly deplete a trader's capital. This dual-edged nature of leverage makes risk management paramount. Traders must carefully consider their leverage ratio and ensure they do not overextend themselves. Using too high a leverage ratio can lead to margin calls, where the broker requires additional funds to cover potential losses, or even the forced closure of positions to prevent further losses. Margin is closely linked to leverage and refers to the amount of money required to open and maintain a leveraged position. Brokers set margin requirements based on the leverage ratio, meaning that higher leverage requires a lower margin. For instance, with 100 to 1 leverage, the margin requirement would be 1% of the total position size. While this enables traders to use less of their own capital, it also means that their account is more susceptible to rapid changes in equity due to market fluctuations. Effective use of leverage requires a disciplined approach to risk management. Traders should use stop-loss orders to limit potential losses and protect their capital. Setting appropriate stop-loss levels helps to ensure that a position is closed before losses exceed a predefined threshold. Additionally, traders should carefully consider their position size relative to their account balance and avoid using the maximum available leverage. By using lower leverage, traders can reduce the risk of significant losses and better manage their overall risk exposure. Furthermore, understanding market conditions and volatility is crucial when using leverage. Markets with higher volatility can lead to larger price swings, which can quickly affect leveraged positions. Traders need to be aware of economic events, news releases, and other factors that can increase market volatility. By staying informed and adjusting their leverage and positions accordingly, traders can navigate the risks associated with leveraging in volatile markets. In summary, leverage is a potent tool in Forex and gold trading that allows traders to control large positions with relatively small amounts of capital. While it can amplify profits, it also increases the potential for significant losses. Effective leverage use requires a thorough understanding of risk management, margin requirements, and market conditions. By using leverage judiciously and employing strict risk management practices, traders can harness its benefits while mitigating its inherent risks. Gold is in move. The London and New York trading sessions are two of the most significant periods in the Forex market, each with unique characteristics that influence trading strategies and market behavior. Understanding the differences between these sessions can help traders optimize their activities and capitalize on the distinct opportunities each session presents. The London session, which runs from 8 a.m. to 4 p.m. Greenwich Mean Time, is the most active Forex trading period. London has historically been a major financial hub, and this session sees a high volume of transactions and liquidity. The London session overlaps with the Asian and New York sessions, making it a critical time for trading. During this period, traders can expect high volatility and significant price movements, especially in currency pairs involving the British pound, GBP, the euro, EUR, and the Swiss franc, CHF. Economic data releases from the UK and the Eurozone often impact market activity, and traders need to stay informed about these announcements to anticipate potential market shifts. Key features of the London session include its liquidity and the variety of trading opportunities available. The high trading volume means that orders are executed quickly and with minimal slippage. This liquidity also allows for tighter spreads, reducing trading costs. Additionally, many of the world's largest banks and financial institutions are active during this session, contributing to the deep liquidity and dynamic market movements. Traders can take advantage of the heightened volatility by employing strategies such as trend trading or breakout trading, which rely on significant price movements. In contrast, the New York session runs from 8 a.m. to 5 p.m. Eastern Standard Time. It begins as the London session is winding down, creating a period of overlap from 8 a.m. to 12 p.m. Eastern Standard Time, which is one of the most active times in the Forex market. The New York session is influenced heavily by economic data releases from the United States, including reports on employment, GDP, and consumer sentiment. These releases can cause sharp market movements, particularly in USD currency pairs. The New York session is also known for its volatility, but it tends to be driven by different factors compared to the London session. The focus shifts more towards U.S. economic news and developments, which can create significant trading opportunities. Major U.S. financial institutions and hedge funds are highly active during this time, contributing to large trade volumes and liquidity. The New York session's impact on market sentiment can be profound, often setting the tone for the rest of the trading day. One key aspect of the New York session is the afternoon lull that can occur after the London market closes. This period may see reduced volatility and lower trading volumes as European traders exit the market, leading to quieter market conditions. However, this can also be an opportunity for traders to reassess positions and plan for potential movements when the Asian markets open. In summary, the London and New York trading sessions are pivotal periods in the Forex market, each with its own dynamics and opportunities. The London session is characterized by high liquidity, volatility, and significant price movements influenced by European economic data. The New York session, while also volatile, is heavily driven by U.S. economic releases and can set the stage for market trends. Traders should tailor their strategies to the unique conditions of each session, leveraging the periods of high activity and adjusting to the shifts in market behavior as the sessions overlap and transition. The expert advisor is on its work. Welcome to all of you, all my viewers, especially who have just joined my live stream. I trade Forex and gold here, and alongside that, I engage in light discussions on various aspects of trading, that is of great value to everyone, especially new traders. The risk-reward ratio is a fundamental concept in trading that helps traders assess the potential profitability of a trade relative to its potential loss. It is calculated by dividing the potential profit, reward, of a trade by the potential loss, risk. The best risk-reward ratio depends on a trader's strategy, risk tolerance, and market conditions, but understanding and applying this concept is crucial for long-term trading success. A commonly recommended risk-reward ratio is 1 to 2, meaning that for every dollar risked, the potential reward should be $2. This ratio ensures that even if a trader only wins 50% of their trades, they can still be profitable. For instance, if a trader risks $100 on a trade with the potential to make $200, they need to win only half of their trades to break even or be profitable. This approach encourages disciplined trading and helps traders maintain a positive expectancy over time. However, the optimal risk-reward ratio can vary based on the trader's style and strategy. Scalpers, who execute numerous trades within a short period, might work with lower risk-reward ratios, such as 1 to 1 or 1 to 1.5, due to the high frequency of trades and smaller profit targets. On the other hand, swing traders and position traders, who hold trades for longer periods, might aim for higher risk-reward ratios like 1 to 3 or 1 to 4, capitalizing on larger price movements and trends. The selection of the best risk-reward ratio also depends on the accuracy or win rate of the trading strategy. A strategy with a high win rate can afford a lower risk-reward ratio because the frequent small profits can outweigh occasional losses. Conversely, a strategy with a lower win rate requires a higher risk-reward ratio to remain profitable. For example, a strategy with a win rate of 40% might need a risk-reward ratio of 1 to 3 to ensure that the wins cover the losses and provide overall profitability. Implementing a favorable risk-reward ratio requires careful planning and discipline. Traders should establish clear entry and exit points for each trade, setting stop-loss and take-profit orders to manage risk and reward effectively. By determining these levels in advance, traders can avoid emotional decision-making and adhere to their trading plan. Additionally, consistently applying a predetermined risk-reward ratio helps traders evaluate and refine their strategies over time. It is also essential to consider market conditions when determining the best risk-reward ratio. Volatile markets may offer more significant profit opportunities but also carry higher risks, potentially justifying higher risk-reward ratios. In contrast, stable markets might require more conservative ratios due to limited price fluctuations. Traders should adapt their risk-reward approach to the current market environment to optimize their chances of success. In summary, the best risk-reward ratio in trading is subjective and varies based on the trader's style, strategy, risk tolerance, and market conditions. While a 1 to 2 ratio is a common starting point, traders must tailor their risk-reward ratios to fit their specific trading approach and objectives. By consistently applying a suitable risk-reward ratio, traders can enhance their profitability and ensure a disciplined, strategic approach to the markets. The expert advisor is analyzing the current dynamics of the market. Successful trading requires discipline, a solid strategy, and consistent habits. Developing these habits can enhance your trading skills and increase your chances of long-term success in the market. Continuous education. One of the best habits for a trader is to continuously educate yourself. Stay updated with market news, economic reports, and geopolitical events that can affect currency movements. Regularly read books, attend webinars, and follow credible sources to improve your knowledge and skills. Continuous education ensures that you stay informed about the latest developments in the market and adapt your strategies accordingly. Developing and sticking to a trading plan. A well-defined trading plan is essential. Outline your trading goals, risk tolerance, and preferred trading strategies. Specify entry and exit points, risk management rules, and position sizing guidelines. Having a trading plan helps maintain discipline and consistency in your trading activities. It also prevents impulsive decisions based on emotions or market noise. Effective risk management. Implementing effective risk management techniques is crucial. Always use stop-loss orders to limit potential losses and never risk more than a small percentage of your trading capital on a single trade, typically 1 to 2%. This approach protects your capital and ensures that a few losing trades do not significantly impact your overall trading account. Proper risk management is the cornerstone of sustainable trading. Maintaining a trading journal. Keeping a trading journal is another valuable habit. Record all your trades, including the rationale behind each trade, entry and exit points, and outcomes. Regularly review your journal to identify patterns, strengths, and areas for improvement. A trading journal provides insights into your trading behavior and helps refine your strategies over time. Practicing patience and discipline. Patience and discipline are key traits of successful traders. Stick to your trading plan and avoid impulsive decisions driven by emotions. Wait for the right trading opportunities that align with your strategy. Patience ensures that you do not enter trades prematurely, and discipline helps you follow your plan without deviation. Staying updated with market conditions. Keep abreast of market conditions by monitoring economic indicators, central bank announcements, and political events that can influence the Forex market. Use a reliable economic calendar to track important events. Staying informed about market conditions allows you to anticipate potential market movements and adjust your strategies accordingly. Diversifying your portfolio. Diversification is a fundamental risk management strategy. Avoid putting all your capital into a single currency pair. Instead, diversify your trades across different currency pairs and possibly other asset classes to spread risk. Diversification helps mitigate the impact of adverse movements in any single market. Utilizing technology and tools. Leverage technology and tools to enhance your trading. Use technical analysis tools, such as charts and indicators, to make informed trading decisions. Consider using automated trading systems or bots to execute trades based on predefined criteria. Technology can improve your trading efficiency and accuracy. Controlling emotions. Controlling your emotions is critical for consistent trading performance. Avoid letting fear, greed, or overconfidence dictate your trading decisions. Practice mindfulness or meditation to stay calm and focused. Emotional control helps maintain objectivity and prevents rash decisions that can lead to losses. Staying healthy. Maintaining a healthy lifestyle is often overlooked but essential for trading success. Regular exercise, a balanced diet, and adequate sleep contribute to mental and physical well-being. A healthy body and mind enhance your ability to make sound trading decisions and sustain long trading sessions. Regularly reviewing and adapting your strategy. Continuously evaluate the effectiveness of your trading plan and strategies. Be willing to adapt and make necessary adjustments based on your performance and changing market conditions. Regular review and adaptation ensure that your strategies remain relevant and effective. Networking with other traders. Engage with trading communities, forums, or groups to share insights, strategies, and experiences. Networking with other traders can provide valuable perspectives and improve your trading skills. Learning from others and discussing different approaches can enhance your understanding of the market. By developing and consistently practicing these habits, you can enhance your Forex trading skills and increase your chances of long-term success in the market. light discussion on various aspects of trading, from risk management to mindset and strategy. In trading, breakouts and false breakouts are critical concepts that can significantly impact a trader's strategy and success. Understanding the difference between the two and knowing how to identify and manage them can help traders make more informed decisions and avoid costly mistakes. A breakout occurs when the price of an asset moves decisively beyond a key support or resistance level, usually accompanied by increased volume. This movement signals a potential continuation of the trend in the direction of the breakout. For instance, if a stock has been trading below a resistance level of $50 and then surges above it with strong volume, it is considered a breakout. Breakouts are significant because they indicate a shift in market sentiment, often leading to substantial price movements as new trends form and traders and investors enter the market. Breakouts can provide lucrative trading opportunities. To trade breakouts effectively, traders often look for confirmation signals, such as a close above the resistance level or below the support level, along with high trading volume. This confirmation helps validate the breakout and reduces the likelihood of entering a trade based on a false signal. Additionally, traders may use other technical indicators, such as moving averages or momentum oscillators, to corroborate the breakout signal. False breakouts, on the other hand, occur when the price temporarily moves beyond a support or resistance level but then quickly reverses direction, failing to sustain the new trend. This can trap traders who entered positions based on the apparent breakout, leading to losses as the price retreats back within the previous range. False breakouts often occur due to low volume, lack of follow-through, or market manipulation, where large players push prices beyond key levels to trigger stop orders and then reverse the direction. To avoid false breakouts, traders should employ several strategies. Firstly, waiting for confirmation is crucial. Instead of entering a trade as soon as the price breaches a support or resistance level, traders should wait for the price to close beyond the level and confirm the breakout. Monitoring volume is also essential, as true breakouts are typically accompanied by a significant increase in volume, indicating genuine buying or selling interest. Low volume during a breakout can be a red flag for a potential false breakout. Using additional technical indicators can also help filter out false breakouts. For example, a trader might look for a bullish crossover in the Moving Average Convergence Divergence (MACD) indicator or an overbought signal in the Relative Strength Index (RSI) to confirm a breakout to the upside. Similarly, bearish signals can confirm a breakdown below support. Risk management is vital when trading breakouts to mitigate the impact of false breakouts. Traders should set stop-loss orders to limit potential losses if the breakout turns out to be false. Placing stop-loss orders just below the support level for long positions or just above the resistance level for short positions can help protect against adverse price movements. Additionally, position sizing should be adjusted to ensure that any single trade does not overly impact the trader's overall portfolio. In summary, breakouts and false breakouts are important concepts in trading that can influence the success of a strategy. Breakouts signal potential new trends and offer trading opportunities, while false breakouts can lead to losses if not properly identified and managed. By waiting for confirmation, monitoring volume, using additional technical indicators, and employing robust risk management practices, traders can enhance their ability to distinguish between genuine breakouts and false signals, improving their overall trading performance. The market is dynamic. Daily gold production is a crucial metric in the global supply of this precious metal, influencing its market price and availability. On average, the world produces approximately 3,000 metric tons of gold annually, translating to roughly 8.2 metric tons per day. However, this figure can vary significantly based on several factors, including mining conditions, technological advancements, regulatory changes, and economic factors. Gold production is predominantly driven by a handful of leading gold-producing countries. Nations such as China, Australia, Russia, and the United States are among the top contributors to daily gold output. These countries benefit from extensive mining infrastructure, rich geological deposits, and, in many cases, supportive regulatory environments. For instance, China, the largest producer, accounts for about 10 to 15% of global daily production, with its extensive mining operations and advanced technology playing a critical role. The daily production of gold is also influenced by the type of mining operations. Large-scale industrial mining projects, which include open-pit and underground mines, contribute the majority of daily output. These operations rely on advanced machinery and technology to extract gold efficiently and at high volumes. In contrast, artisanal and small-scale mining, ASM, which is prevalent in regions like Africa and South America, contributes a smaller portion to daily production but is significant in local economies and communities. Market conditions and gold prices also impact daily gold production. When gold prices are high, mining companies are incentivized to increase production to capitalize on the favorable market conditions. Conversely, when prices are low, some operations may scale back production or temporarily shut down, reducing daily output. Additionally, the cost of production, which includes factors such as labor, energy, and materials, can influence the volume of gold mined each day. Environmental and regulatory factors play a crucial role in daily gold production. Stricter environmental regulations and sustainable mining practices can affect the speed and volume of gold extraction. Companies are increasingly required to implement measures to minimize environmental impact, which can sometimes slow down production processes. Regulatory changes in major gold-producing countries can also lead to fluctuations in daily production levels, depending on how favorable or restrictive the new policies are. In summary, daily gold production is a dynamic and multifaceted process influenced by geographical, technological, economic, and regulatory factors. Understanding these elements provides insight into the complexities of gold supply and its impact on global markets. Gold remains dynamic over time. The daily trading volume in the Forex, foreign exchange, market is among the highest of any financial market in the world. On average, the Forex market sees a daily trading volume of over $6 trillion. This immense volume reflects the global nature of currency trading, involving a vast array of participants including banks, financial institutions, corporations, governments, and individual investors. The Forex market operates 24 hours a day, 5 days a week, across major financial centers like London, New York, Tokyo, and Sydney, contributing to its high liquidity and continuous activity. The major currency pairs, such as EUR, USD, USD, JPY, and GBP, USD, account for a significant portion of this daily volume. The high trading volume in these pairs is driven by their liquidity, tight spreads, and the substantial economic activities of the countries involved. Additionally, the Forex market's decentralized nature means that trading occurs over the counter, OTC, through a network of banks and brokers, facilitating extensive trading activity around the clock. In contrast, the daily trading volume of gold, while substantial, is significantly lower than that of the Forex market. On average, the gold market sees a daily trading volume of around $145 billion. This volume includes trading on various exchanges such as the London Bullion Market, the largest global center for over-the-counter gold trading, the COMEX in New York, the leading futures market for gold, and other regional exchanges. The gold market's trading volume is driven by various participants, including central banks, institutional investors, hedge funds, and retail investors. Gold is traded in several forms, including physical gold, bars and coins, futures contracts, options, and exchange-traded funds, ETFs. Each of these forms caters to different types of investors, from those seeking physical ownership to those looking to speculate on price movements or hedge against economic uncertainties. Gold trading is influenced by factors such as economic data releases, geopolitical events, and movements in other markets like currencies and equities. Its status as a safe haven asset means that demand can surge during periods of market turmoil or geopolitical instability, leading to higher trading volumes. Conversely, in more stable times, the volume may decrease as investors shift their focus to other assets. In summary, while the daily trading volume of gold is substantial at around $145 billion, it pales in comparison to the Forex market's staggering $6 trillion. The Forex market's vast volume reflects its global, decentralized, and highly liquid nature, whereas gold trading, despite being significant, is more specialized and influenced by specific economic and geopolitical factors. Both markets play crucial roles in the global financial system, offering unique opportunities for various types of investors. Keep your emotions in control while trading. Fear and greed can lead to irrational decisions. Several key factors affect the price of gold, influencing its appeal as an investment and its market performance. One of the primary factors is the movement of the US dollar. Since gold is typically priced in dollars, a stronger dollar makes gold more expensive for buyers using other currencies, thereby reducing demand. Conversely, a weaker dollar tends to make gold more affordable and attractive, driving up demand and, consequently, its price. Another significant factor is inflation. Gold is often considered a hedge against inflation. When inflation rates rise, the purchasing power of money declines, making gold a more appealing store of value. Investors turn to gold during periods of high inflation to preserve their wealth, leading to increased demand and higher prices. On the other hand, when inflation is low and stable, the urgency to invest in gold diminishes. Geopolitical tensions and economic uncertainty also play crucial roles in determining gold prices. During times of political instability, conflict, or economic crises, investors seek safe haven assets like gold to protect their investments from potential losses in other markets. This flight to safety typically results in a surge in gold prices. For example, escalating conflicts or significant political events can drive investors towards gold, causing a spike in its value. Additionally, interest rates set by central banks influence gold prices. Lower interest rates reduce the opportunity cost of holding non-yielding assets like gold, making it more attractive to investors. Conversely, higher interest rates increase the attractiveness of yield-bearing investments over gold, leading to a potential decrease in its price. Decisions and outlooks from central banks, particularly the Federal Reserve, are closely monitored by the market for indications of future interest rate policies. Lastly, supply and demand dynamics are fundamental to the price of gold. Gold production from mines, recycling of old gold, and central bank activities in buying or selling gold reserves all impact the available supply. On the demand side, jewelry consumption, industrial use, and investment demand are critical factors. Any significant changes in these areas can lead to fluctuations in gold prices. For instance, a decline in gold production or an increase in jewelry demand from major markets like India and China can drive prices higher. In summary, the price of gold is influenced by a complex interplay of factors including the strength of the U.S. dollar, inflation rates, geopolitical and economic uncertainties, interest rates, and supply and demand dynamics. Investors must consider all these elements when making decisions about gold investments. The market is in action. Selecting the best technical indicator for gold trading can significantly enhance a trader's ability to make informed decisions and optimize returns. One of the most effective and widely used technical indicators for gold trading is the Relative Strength Index, RSI. The RSI is a momentum oscillator that measures the speed and change of price movements, oscillating between 0 and 100. It is typically used to identify overbought or oversold conditions in the market, with readings above 70 indicating overbought conditions and readings below 30 indicating oversold conditions. The RSI is particularly useful for gold trading due to its ability to highlight potential reversal points. Gold, being a highly volatile asset, often experiences rapid price movements. By using the RSI, traders can identify when gold is potentially due for a correction after a significant price surge or drop. For example, if the RSI indicates that gold is overbought, traders might anticipate a price pullback and consider selling or taking short positions. Conversely, if the RSI shows that gold is oversold, it could be a signal to buy or take long positions in anticipation of a price rebound. Another valuable technical indicator for gold trading is the Moving Average Convergence Divergence, MACD. The MACD is a trend-following momentum indicator that shows the relationship between two moving averages of a security's price. It consists of the MACD line, the signal line, and the histogram. When the MACD line crosses above the signal line, it generates a bullish signal, suggesting it may be a good time to buy. When the MACD line crosses below the signal line, it generates a bearish signal, suggesting it may be a good time to sell. The MACD is effective in identifying trend reversals and the strength of a trend, which is crucial for trading in the volatile gold market. Additionally, Bollinger Bands can be an excellent tool for gold traders. Bollinger Bands consist of a middle band, usually a simple moving average, and two outer bands, standard deviations from the moving average. These bands expand and contract based on market volatility. When gold prices move closer to the upper band, the metal might be overbought, and when prices move closer to the lower band, it might be oversold. This helps traders to visualize price volatility and identify potential entry and exit points. Finally, combining multiple indicators can often yield the best results. For instance, using the RSI in conjunction with the MACD can provide a more comprehensive view of the market. If both indicators simultaneously signal a reversal or a continuation of a trend, it can strengthen a trader's confidence in their trading decision. Moreover, incorporating indicators like Bollinger Bands can add another layer of insight, especially in identifying volatility and potential breakout points. In conclusion, while the RSI, MACD, and Bollinger Bands each have their strengths, the best approach often involves combining these indicators to gain a more nuanced understanding of gold's price movements. This multi-indicator strategy can help traders navigate the inherent volatility of the gold market, making more informed and profitable trading decisions. Stay informed about global economic and geopolitical developments, as they can influence market movements. The gold market operates across various time zones and regions, making it a continuous and globally interconnected market. Major gold trading hubs include London, New York, Zurich, Hong Kong, and Sydney, each with their own specific trading hours that contribute to the round-the-clock nature of the market. The over-the-counter, OTC, market, where most gold trading occurs, does not have a centralized exchange or fixed trading hours, allowing for flexible trading arrangements between parties. London is one of the primary centers for gold trading, and its market hours play a significant role in global gold prices. The London Bullion Market Association, LBMA, sets the benchmark prices for gold, with trading typically occurring between 8 a.m. and 5 p.m. Greenwich Mean Time. The twice-daily, London Gold Fixing, at 10:30 a.m. and 3 p.m. Greenwich Mean Time establishes a standard price used by the industry. These sessions are crucial for price discovery and liquidity. New York's gold trading activities are centered around the COMEX, a division of the New York Mercantile Exchange, NYMEX. COMEX trading hours run from 8:20 a.m. to 1:30 p.m. Eastern Time, ET, providing a critical overlap with London trading hours and ensuring significant market liquidity. The COMEX is known for its futures contracts, which are influential in hedging and speculative activities related to gold. Zurich, another important gold trading hub, operates primarily through major banks and financial institutions, contributing to the global flow of gold transactions. The Swiss market generally aligns with standard European trading hours, from 9 a.m. to 5 p.m. Central European Time, CET. Zurich's prominence in gold refining and storage also underscores its strategic role in the gold market. In Asia, Hong Kong and Shanghai are key centers for gold trading. The Hong Kong market opens from 9 a.m. to 4:30 p.m. Hong Kong time, HKT, bridging the time gap between Western and other Asian markets. Meanwhile, the Shanghai Gold Exchange, SGE, operates from 9 a.m. to 3:30 p.m. China Standard Time, CST, with a break between 11:30 a.m. and 1:30 p.m. The SGE is notable for its influence on physical gold demand and pricing in China. Lastly, Sydney's gold market, though smaller, contributes to the 24-hour trading cycle. The Australian Securities Exchange, ASX, opens for gold trading from 10 a.m. to 4 p.m. Australian Eastern Standard Time, AEST. This early opening in the global cycle provides continuity after the New York market closes. In summary, the gold market is characterized by its continuous operation, with key trading hubs around the world ensuring liquidity and price discovery across different time zones. The interplay between these markets allows for a dynamic and responsive trading environment, reflecting global economic and geopolitical developments. The gold market is playing its game.